Joining us to talk about what to expect is Brian Levitt. He's global market strategist for North America at Invesco. Also, David Lebovitz, who is global market strategist at JP Morgan Asset Management. And gentlemen, good to see both of you guys. Brian, why don't we start with you? Let's just talk a little bit about earnings season so far. It's been better than expected. Is that a reason to jump in and support stocks here?
Well, earnings season's almost always better than expected, right? So we get really negative and then companies surpass expectations. I think what we had was an environment in the summer where economic growth had deteriorated pretty significantly amid all the policy uncertainty, particularly around trade. And, but companies are finding a path. They're figuring out how to overcome some of these obstacles. And importantly, the policy sentiment is improving. And you're seeing that in interest rates. You're seeing that in the shape of the yield curve. And all of that is an improved sentiment. I think it's good for the markets.
David, with all that improved sentiment, is that a reason to think that the Fed won't lower rates this time around? And what would that mean?
So, I don't think we should put the cart before the horse with respect to October. It sounds like there's a little bit more balance at the Fed today than there was a few months back. But I do think there's at least one rate cut in store between now and the end of the year. I think if the Fed, if all possible, wants to be on the sidelines in 2020, given the election. So I think that there's a chance that they, maybe even go twice before the end of the year to allow them to do that. Coming back to earnings, I would agree that, it's been better than expected, but the underlying drivers are a little bit concerning. You continue to see margins deteriorate. Buybacks are playing a pretty significant role when it comes to supporting earnings growth going forward. And so, we think about the remainder of this year, kind of the third quarter might be tough. Fourth quarter should see a nice bounce back due to base effects. But we have some questions around what 2020 looks like. To us, that's a low single digit growth rate, which when the fundamentals begin to soften, if a lot of these geopolitical risks are not resolved, that's obviously going to lead to elevated volatility and a jumpier market.
We looked at the S&P pushing above 3,000 yesterday. You don't think it's going to stay there?
I just think it's interesting that we are so close, less than 1% from an all-time high, with Brexit and trade still unresolved. To me, that's the market pricing in an outcome that I think may come eventually, but may not come as quickly as what investors are currently looking for. So I think we might be a little bit ahead of ourselves.
I think investors need to take a step back and make sure they get the big story right. And the big story for the last number of years has been a slow growth world with benign inflation and policymakers stepping in to support growth anytime we seem to have these slowdowns. And so that continues, and that's why the markets continue to press higher. It's an environment where policy is marginally improving. Stocks continue to be cheap to bonds. No real signs of inflation, no real signs of the economy being over-levered. In my opinion, this cycle goes on longer than most people suspect.
Well, not to mention that we really haven't gone anywhere in a year.
Well, we haven't gone anywhere in a year. I mean, what we've dealt with is corrections amid policy uncertainty. So this is the third time in this cycle that we've dealt with a sharp slowdown in economic activity amid policy uncertainty, the market trying to find its footing within that. The Fed's backed off. We see at least an improving tone on trade, and that's really what the markets are looking for. And financial conditions have eased meaningfully. Yeah. That should be good for equities.
Not to mention the trade war. You might anticipate you're not going to see quite as much angst between the two, or quite as much ramping up both sides. Seems like they are ready for a deal.
I think the pot was beginning to boil, and both sides recognized it, and so they took the top off for a few minutes, and they let it return to more of a simmer. I think that there's still a lot that needs to be discussed. We really haven't seen anything in writing on this phase one skinny deal, so I think important not to make a mountain out of a molehill. And from where I sit, the big question for the economy going forward is, I'm not sure that even if we see a deal on trade, you see a return to robust manufacturing activity. I think businesses are generally
Bottom
cautious.
Line, you're cautious.
I'm a bit cautious.
You would not be putting money to work here.
I think that in equities, it's a little bit challenging to put money to work with this close to an all-time high.
Brian, you seem much more bullish.
Yeah, I'm optimistic. I mean, I think what we've dealt with a period of negativity, and we've dealt with a period where long rates went down and defensive parts of the market worked. I think it's too late to get defensive. And what starts to happen now is policymakers have responded to a growth scare. We're not all the way there, but we're improving, and that should be a better backdrop for markets.
What do you buy right now?
I would buy, again, it's too late to be defensive, so I would buy the more cyclical parts of the market, which had gotten pretty cheap. And, you know, for investors longer term, you're going to have a short move in the more value-oriented parts of the market, but it's going to continue to be a growth in a slow growth world. And I would start to even look outside the United States. I know we've been saying, I know it has not been the place to be, but a better policy mix, some stimulus from China, that should start to unlock some of the value that exists in the emerging economies.
Yeah, I mean, from where we sit, it's all about income at the current juncture, and whether you get that income from high-yield bonds, whether you get that income from financial stocks. We think pairing a little bit of cyclicality with an income-focused approach with more defensive assets is probably the right way to go going forward. That way, you know, if Brian's right and I'm wrong and the market keeps climbing higher, you participate in that upside. But if things do retrench on some sort of idiosyncratic shock, you have duration in your portfolio to help offset that downward move in risk assets.